Hello, and thank you again for taking the time to check out another brief video brought to you by myself, Dan Scharlach, and my firm, Innovative Wealth Partners. Today, we are going to spend our time talking about fixed annuities, some of the pros and cons to fixed annuities, and some of the demographics or the ages when you might want to consider using a fixed annuity and those that you would not want to consider using a fixed annuity. The place we are going to start is by focusing on the interest rate that you earn as an investor. That is the primary reason that people are attracted to fixed annuities these days. They're actually paying, in our opinion, oftentimes slightly higher interest than what you are going to typically see at a local bank or financial institution who is offering a certificate of deposit. I would say that CDs and fixed annuities rival each other in the marketplace and compete for investors' business. One, the CD is going to be offered through a bank, and the insurance company offers fixed annuities. That is going to be one of the differences. That is potentially going to be one of the pros and cons. You can define which asset type class you would want to have your guarantee provided by. But obviously, one's going to be backed by the insurance companies, and the other is going to be backed by the banking industry. We like to see people remember the idea of balance, so it does not scare us at all that these insurance oriented products are the people providing the guarantee behind fixed annuities. Some of the other subtle differences are going to be taxes. Taxes on a CD are owed and paid each and every year. Taxes are not tax deferred, whereas a fixed annuity is going to be tax deferred. That simply means that you do not pay the tax as you accumulate your money each and every year. Tax deferred simply means that you will pay the tax when you pull the money out. You'll owe all of the tax as ordinary income at that point in time. Okay, pretty simple, but it is a major difference. You can define for yourself whether that is a pro or a con, whether that is positive or negative. It is very specific to your situation, most likely. But it is a major difference in the two. One of the other differences in the two are the fact that if you are not 59 and a half and you pull money out of a fixed annuity, you will incur, most likely, a 10% penalty on the game. So that is a fairly big difference. In our opinion, you would not incur that on a banking oriented product. So this is really designed for somebody who understands and is comfortable with that risk, or somebody who is within a few years of 59 and a half. That's another place to focus. There are not actually a lot of differences in the duration on these products. So CD durations or terms are going to be very similar to fixed annuity terms. Our experience is that 3 5-year termed contracts in the fixed annuity world offer the most competitive rates today, and those are actually the one that exceed the CDs by the most. So that is what has drawn the most attention, in our opinion, and will continue to do so most likely. However, that can change over time. We would encourage you to check rates often and to keep that in mind when making your decision. The other, I would say, difference or divergence from a CD, CDs have penalties, and that's not something we're going to focus on today. However, fixed annuities have something called surrender charges. Surrender charges decrease over time the closer you get to the end of the contract or the maturity of the contract, which means the same thing. Typically, on a 5-year annuity contract, you are going to see that surrender charge go down each and every year. This is an attempt by the insurance company to recoup a little bit more of their costs, and that is how they're actually able to pay you a little bit more in earnings or in a yield, in a return, is because they do have a surrender charge, which, like I said, does decrease over time. The other aspect that we feel like is important to consider in today's marketplace is the simplicity of these products. So, CDs are obviously very simple. Fixed annuities are also extremely simple and easy to understand. You get a stated rate of return. You, like I said, have a certain term on your contract, and you typically would have a guarantee on that contract. The other aspects of this that you will see as you go and do your research are the fact that the annuity concept in general, if you look this up, you will see gets a lot of positive, but more so negative hype in our industry. And I would encourage you to know that there are multiple types of annuities. Okay, there's fixed, which is what we're talking about, and then there's actually two major subject headings when it comes to annuities. We are not going to get into that today, but do not think that just because you hear somebody blasting the idea of an annuity, that all annuities are the same. This is not the case. It's very similar to how we function with our diets, right? So some people would say that fat is bad. Well, I would argue that not all fats are bad. And it's very similar to that when we're dealing with financial matters. So, fixed annuities can have a very legitimate place in someone's financial life, in our opinion.